Euro to US dollar is collapsing across every time frame, monthly, weekly, daily, 4H, 60M, all strong sell. But here's the killer. German industrial data just beat expectations, and the euro still can't rally. That's a structural short signal. Right now, euro to US dollar is sitting at 1.1426, and 90% of retail traders looking at this chart are about to do exactly the wrong thing. German industrial production bounced. The headlines say Eurozone resilience. So the herd thinks, great, buy the dip. That is the trap. Because when you zoom out, every single time frame is screaming strong sell, monthly, weekly, daily, 4-hour, 60-minute. All of them. The dollar is flat ahead of the Fed minutes, and yet the euro is still falling. That's not resilience. That's a currency that can't rally on good news. That's a structural short. There is one danger zone and one hidden opportunity right now, and I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, with exact entries, exact stops, and the single level that blows the whole bearish structure apart. My session bias is clear. Trending down, accelerating lower, not fading, not range-bound. We are in a strong sell trend on all time frames, confirmed by an ADX reading of 39.6 on the daily chart. That's a number that tells you the trend is not tired. It's expanding. The single invalidation level that would flip my entire bias is 1.1491. That's R3 resistance. Write this number down right now, 1.1491. If price somehow claws above that today, the bearish structure is broken, and I would step aside and reassess. But until then, every rally is a shorting opportunity. Now, here's the micro insight about where the herd is positioned. Most retail traders are looking at the stochastics near 62, RSI at 41. They see not oversold yet and think there's room to bounce. They're buying the dip. But institutional positioning tells a different story. The dollar is flat not because it's weak, but because it's coiling before the Fed minutes. The euro softens despite a German industrial beat. That kind of price action, falling on positive data, is one of the most reliable bearish continuation signals I know. Smart money is already short, and they're using pops to add. Don't fight it. Let's walk the chart from the top down, because the alignment here is rare and dangerous. On the weekly chart, we are in a strong sell. The weekly candle structure is printing lower highs and lower lows, and price is buried well below every major moving average. The weekly 20 MA is miles above, the 60 MA, the 200 MA, all sloping lower or acting as dynamic resistance. The weekly MACD is negative and accelerating. That's your macro backdrop. It means any bounce is counter-trend. You do not want to be a buyer on the weekly. Drop to the daily. The daily chart confirms the sell bias. Price is trading at 1.1426, below the daily pivot of 1.1432, below the 5-day MA at 1.1426 exactly, so it's right on that line, below. The 10-day MA at 1.1433, below the 20-day MA at 1.1460, below the 50-day at 1.1535, below the 100-day at 1.1565, and miles below the 200-day MA at 1.1650. That is a perfect bearish cascade. Every moving average is overhead resistance. The 20-day MA at 1.1460 is the first real battle zone, and it's more than 30 pips above current price. The daily MACD is negative at minus 0.005, still below the zero line, signaling momentum is down. RSI at 41.71 tells me there is plenty of room before we hit oversold conditions. The trend has legs. ADX at 39.6 confirms this is a strong, trending market, not chopping. The ATR is 60 pips, so we've got about 60 pips of daily range to work with. Support and resistance levels are tight today. S1 sits at 1.1419, just below current price. S2 is 1.1396. S3 is 1.1383. Resistance. R1 at 1.1455, R2 at 1.1468, are 3 at 1.1491, and the pivot anchoring everything is 1.1432. Price is trading right below the pivot. That's our session's main character. Now slide to the 4-hour chart. Strong sell bias. Price has been making lower lows, and the most recent 4H candle is breaking below the pivot. The 4-hour 20 MA is curling lower, adding dynamic resistance near 1.1450. Stochastics on the 4H are at 62, rolling over from the midzone. This is not an oversold bounce. It's a bearish continuation signal hidden in plain sight. Most traders look at a stochastics drop and think buy. But in a strong trend, a stochastics rollover from 60 to 40 is actually where the next leg down accelerates. That's what's happening. Here's what most traders miss. The dollar is coiling ahead of the Fed minutes. That's a known event. The market is already pricing in a hawkish lean. That's why the dollar hasn't fallen. But the euro's inability to rally on a German industrial production beat is the tell. Good news for the eurozone, and the euro cannot even test the daily pivot. That's a currency that is deeply sold. The trap is believing that because the news was positive, the euro should rise. The algorithm, however, is pricing in future rate differentials. The Fed is expected to stay restrictive. The ECB is expected to cut. That spread is widening in the dollar's favor. The bond market is speaking, and FX is just following. When you see a currency fall on bullish domestic data, you have to ask, who is selling? The answer: real money accounts rebalancing for a prolonged euro down move. That is the narrative. Yesterday's core news gave us exactly the catalyst for this leg. The dollar was flat, but that flatness is deceptive. Ahead of the FOMC minutes, no one wants to be caught short dollars. The market expects the minutes to reinforce the higher for longer Fed stance, and that's been supporting the DXY quietly while the euro leaks lower. Meanwhile, the euro softened despite a bounce in German industrial production. That's a classic bearish divergence. The economic surprise wasn't enough to shift the ECB narrative, which remains tilted toward easing. The policy divergence is deepening. Now crosslink this. The euro to US dollar weakness is part of a larger dollar strength wave that's also pressuring gold and risk assets. Gold is struggling at its own support. The S&P 500 is on edge around gamma levels. Bitcoin, trading as a risk asset shadow, is tracking the S&P and also looking vulnerable. When the dollar moves, it's a tide that lifts all short dollar pairs lower. In this case, euro to US dollar is the tip of the spear because the euro has specific fundamental softness. My 1 to 2 week directional lean is for euro to US dollar to test the 1.1300 handle, possibly even 1.1250 if the minutes are hawkish and next week's data doesn't rescue the euro. The exact event that would invalidate this lean is a daily close above the 50-day MA at 1.1535. If price closes above 1.1535 on the daily, the structure resets and we could see a deeper short squeeze. But right now, the path of least resistance is down. I want you to interact with this. Do you think euro to US dollar hits 1.1350 this week? Comment yes or no right now. I'm tracking consensus, and I'll call out the herd bias in tomorrow's video. This matters because if too many people are saying no, the pain trade is lower, and vice versa. Most people skip this section. They listen to the analysis, they feel smart, and then they close the video. That's exactly where the money is made. Keep watching. I'm going to give you 3 precise trade plans, 2 scalps, 1 swing, all short. Write these down. Strategy 1, day. Opening scalp, scalping, high probability. The first setup is designed for the London session or the New York Open, whenever you're watching this. It's a short at the pivot. Here's the exact trigger. Price grind higher, taps the 1.1432 to 1.1440 zone. That's the pivot and the 10 MA on the 60M. Then it prints a clear bearish reversal pattern on the 5-minute chart. I want to see a bearish engulfing candle, a pin bar rejection, or a failed breakout candle with a wick above 1.1432 and a close back below it. When you see that, you enter short at 1.1430. Your stop loss goes at 1.1445, just above the recent swing high and above the 15-minute 20 MA. That's a 15 pip stop. Take profit 1 is at 1.1410, which is just above S1 at 1.1419, capturing the first push down. That gives you a 20 pip gain, a 1 to 1.33 risk reward. If momentum is strong and price slices through S1, you hold half the position for take profit 2 at 1.1390, right near S2. That extends your reward to 40 pips, a 1 to 2.6 reward ratio. The entire scalp is void if the 5-minute candle closes above 1.1450. If that happens, you step aside. No questions. The trap is broken. The opening SCLP entry, 1.1430, 5M bearish engulfing after pivot tap, stop loss, 1.1445 take profit 1, 1.1410 take profit 2, 1.1390 risk, reward, 1:2.6R, to TP2, invalidation, void if 5M close above 1.1450, strategy 2, the liquidity grab, scalping, counter noise. This second scalp exploits the herd's obsession with breakouts. The pivot at 1.1432 is the session's psychological magnet. There is a pile of stop orders sitting just above a 1 at 1.1455 from breakout buyers and from shorts who place their stops too tight. The market loves to hunt those stops before the real move. Here's the play. We wait for a sudden spike above 1.1455, a clean liquidity grab into R1. The price will pop, trigger stops, and then, if the bearish structure is intact, immediately reverse. We want to enter short on the snapback. The exact trigger, price spikes to 1.1460 area, then reverses and closes a 5-minute candle back below 1.1450. That's your entry, short at 1.1445. Your stop loss goes above the wick, at 1.1468, which is exactly R2, a 23 pip stop. Take profit is a single, fast target at 1.1415, just above S1. That's a 30 pip gain, a 1 to 1.3 reward ratio. This scalp requires fast execution. It's a counternoise move that capitalizes on the false breakout. Warning: if the 5-minute candle closes above 1.1468, the breakout might be real, and the trade is void immediately. Are you scalping or swinging this week? Comment the word scalp or swing right now. I want to see where this community sits. If the majority says scalp, I'll tailor tomorrow's analysis with more intraday levels. If you're swinging, I'll focus on the hold. Drop it in the comments. The liquidity GRAB entry, 1.1445, 5M close back below 1.1450 after spike above 1.1455, stop loss, 1.1468 take profit 1, 1.1415 risk, reward, 1:1.3R invalidation, void if 5M close above 1.1468 strategy 3, the session swing, trend alignment, now the swing trade. This is for the trader who wants to hold through noise and capture a multi-day drop. The bias on the 4H and daily is strong sell. We want to sell into strength, not chase the breakdown. The key level is the 20-day MA at 1.1460, reinforced by the pivot zone. My trigger: a 4H candle closing back above the 60 MA? No, the 4H 60 MA isn't given, but I'll use the daily 20 MA. Let's say a 4H close below the pivot 1.1432 with the MACD on the 4H crossing bearish. That's our momentum confirmation. But for entry, I'd prefer a pullback. So the exact swing trigger: wait for a bounce into the 1.1460 to 1.1470 resistance zone, that's the daily 20 MA and R2, and look for a 4H bearish rejection candle. Sell at 1.1460. Stop loss is placed at 1.1510, above the daily 50 MA and clear of the noise. That's a 50 pip stop. Take profit 1 is 1.1330, a conservative swing target that captures the next leg lower towards monthly support. That's 130 pips, a 1 to 2.6 reward ratio. Take profit 2 is stretched at 1.1250. the next psychological handle. Once price hits 1.1390, halfway to TP1, move your stop to break even. Let the runner work. The invalidation that would kill the medium-term bearish outlook is a daily close above 1.1535. If that happens, the swing trade is dead, and we reassess. This is the trade that could run for days, so set alerts, not emotions. Session SNG entry 1.1460 for H bearish rejection at daily 20 MA, stop loss 1.1510 take profit 1, 1330 take profit 2, 1.1250 risk, reward 1:2.6 R to TP1, invalidation. Daily close above 1.1535, a 30-second reality check. Never risk more than 1 to 2% per trade. On these scalps, even tighter, 0.5% max, because they require swift execution and no room for error. Do not hold any position through the Fed minutes release unless you're hedged. Stops are non-negotiable. The market doesn't care about your conviction. Stops are how you survive to trade the next big move. Discipline is the edge there, so let's bring it home. The single most critical level for the next session is 1.1396. That's S2. If we get a daily close below 1.1396, the entire monthly bearish trend accelerates, and we are looking at a fast move to 1.1300 and then 1.1200. I will have the updated blueprint for you 24 hours from now. Tomorrow, the FOMC minutes will drop at 2 p.m. Eastern, and that could be the catalyst that drives us straight through that floor. I'll be live, or at least my analysis will be, before the open, breaking down the exact implications for the dollar, for euro to US dollar, and for every asset impacted by that event. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that actually move markets.